You know, you are probably staring at your brokerage app right this second.
Oh, absolutely.
Like, let's just be completely honest here. You are sitting on, say, 200 shares of Amazon. You bought in at a $227 cost basis.
And you're just watching that ticker.
Right. The ticker is flashing red, then it flashes green, then it just goes back to red again. And you're sitting there wondering if you should panic, if you should hold, or if you should, double down.
It's terrifying.
It really is. Welcome to the deep dive. Today, we aren't just looking at these pristine, polished balance sheets. We are tearing them apart.
We have to.
Yeah, because it is Thursday, May 7, 2026, and the tech market is currently experiencing the kind of severe turbulence that, well, it keeps portfolio managers awake at night.
Oh, they aren't sleeping. Nobody is sleeping right now.
Exactly. We are in the dead center of the most expensive artificial intelligence arms race in human history.
Right. Companies are just dropping tens of billions of dollars a quarter.
Yeah, on capital expenditures, just trying to secure the data centers and the silicon they need to survive.
And the broader market is just ruthlessly reevaluating everything.
Right. The tolerance for missing earnings or even just issuing soft guidance is basically zero right now.
It is a completely unforgiving environment today. I mean, we are looking at a market where the fundamental, chartered financial analyst level accounting is violently colliding with the gritty, almost irrational psychology of technical analysis.
Yeah, those two worlds rarely mix.
Right. You have these fundamental analysts who spend all day reading 10K filings, and then the technical analysts who just read price charts, and they do not speak the same language.
But right now, you can't understand the valuation of Microsoft or Amazon, NVIDIA, Google, unless you fluently speak both, right?
Exactly. You have to strip away the accounting illusions to find the real cash flow. But you also have to understand the sheer human terror that's driving the daily price action.
Yeah. Right, because before we can even get to the raw accounting, we have to deal with the immediate reality of what the stock is doing today.
Yeah, the chart itself.
Exactly. People look at stock charts and they see these lines drawn all over them. Support levels, resistance levels, moving averages. It looks like geometry.
But it's not.
Right. Those lines aren't physical laws. A support level isn't like gravity. It's just human feelings.
Yes. Specifically, regret and greed.
Yeah, manifesting physically as a line on a chart.
That is the perfect starting point, actually. When you see a quote-unquote support level hold up a falling stock, you are witnessing a temporary consensus built entirely on group psychology.
It's like an invisible emotional tug of war.
It is an intense tug of war, and it's driven by three very specific actors in the market. So first, you have the regretful.
Okay, so these are the people who missed the boat the first time around.
Exactly. Imagine NVIDIA was consolidating at $120 for months. A massive group of investors watched it, they debated it, and ultimately they hesitated.
Right, they didn't pull the trigger.
Yeah, and then suddenly a positive earnings report hits, and the stock just shoots up to 140.
Oh, that hurts.
The psychological pain of missing out is acute. It literally physically hurts to see your peers making money while you sat on the sidelines.
But what do?
They form a mental contract with themselves. They say, if this stock ever drops back to 120, I am not thinking. I am backing up the truck and buying.
So their regret literally creates a floor.
Exactly.
They are providing this deferred wall of buying pressure, just waiting for the price to drop.
Precisely. The moment the stock dips to 120, that wave of capital rushes in, arresting the fall. But, they aren't acting alone. You also have the second group, which is the greedy.
The greedy. Okay, so who are they?
These are the investors who actually did the homework. They bought the stock at 120, and they rode it all the way up to 140.
So they're feeling pretty smart.
Their confidence is sky high. Their thesis was proven right. So when the broader market panics and the price dips back to 120, they don't see a crisis.
They see discount.
Right. They see a Black Friday discount on a fundamentally sound asset, so they double down.
Which adds a second layer of buying pressure to that exact same price point.
Exactly.
Okay, so you've got the people who missed out, the people who want more. But there is a third pillar supporting that floor. And ironically, it's the people who actively hate the stock, right?
Yes. The fearful, specifically the short sellers.
Right.
These are the traders who borrowed the stock and sold it at 120, betting the company was overvalued and that the price would collapse.
But instead, it ripped to 140.
Right, and they watched in absolute agony. They have been losing sleep, taking margin calls, sweating out the rally.
So what happens when it drops back down?
When the price finally drops back down to their original break-even point of 120, the psychological relief is just overwhelming. And to close a short position, you are legally required to buy the stock back in the open market.
Oh, wow. So the people betting against the stock are forced to become buyers at the exact same level as the bulls.
Yes, exactly.
That creates an incredibly dense concentration of buy orders right at that 120 mark.
It's massive.
So bringing this to the present day, what are the actual key psychological anchors we are looking at in this tech sector right now?
Well, let's look at Amazon. It is currently testing a critical psychological anchor right at $200.
Which is a nice, round, even number.
Yeah, human brains are naturally drawn to round numbers for simplicity. But the more alarming example right now is Microsoft.
Right. Microsoft.
They recently shattered a massive support level at 450.
And the catalyst for that was earnings fears, wasn't it?
Yes. They announced $37.5 billion in capital expenditures for AI infrastructure over the coming quarters.
Wow.
And the market completely balked at the price tag. When that 450 support broke, Microsoft entered what technical analysts call a vacuum zone.
A vacuum zone. That implies there are literally no buyers left. Like the floor gave way and there was nothing but air underneath.
Exactly. It was a free fall straight toward 400. And below that, its massive 200-week moving average is sitting even lower, around 350.
Yeah.
Meanwhile, NVIDIA experienced a sharp 16% pullback post-earnings, and it is currently hovering around 177.
Which places it right at its 200-day moving average, right?
Precisely.
Let's pause on that Microsoft example for a second because it highlights a really brutal rule of market mechanics. If that 450 floor breaks and the stock crashes to 400, that 450 line doesn't just disappear, it transforms.
It becomes tomorrow's resistance.
Right.
Think about the psychology of all those people who bought Microsoft at 450, thinking they were catching the bottom. The moment the price crashed to 400, they were trapped in a massive losing position.
Oh, man. They spend weeks, maybe months, staring at a red portfolio feeling completely foolish.
Yeah. So if the price slowly recovers and grinds its way back up to 450, those trapped buyers aren't looking to make a profit anymore.
No, they just want out.
They just want the psychological release of breaking even. They breathe a sigh of relief and immediately hit the sell button to get their original money back.
So that massive wall of relief selling turns the former floor into this impenetrable ceiling. That makes perfect sense on an individual psychological level. But here is the massive disconnect I'm seeing in the sources.
Okay, what is it?
When people think of technical analysis, drawing trend lines, looking at 200-day moving averages, they imagine a retail day trader in his basement.
Right, the guy with 6 monitors.
Exactly. But the reality is that institutional investors, the massive suit-wearing fundamental analysts managing billion-dollar funds, are actually the biggest drivers of technical analysis.
They absolutely are.
How does a fundamental hedge fund end up relying on a chart line?
It comes down to the sheer physics of volume and algorithmic trading. You have to remember that over 80% of Wall Street trading is executed by algorithms.
Wow, 80%.
Yeah. The 200-day moving average isn't some mystical boundary. It becomes a self-fulfilling prophecy because thousands of servers and data centers across New Jersey are running code that triggers buy or sell orders the exact millisecond the price touches that specific pixel on a chart.
But hold on. If a massive hedge fund wants to dump a 10 million share position in Microsoft because they hate the fundamentals, they don't care about the 200-day moving average.
True.
They have billions of dollars of institutional selling power. Couldn't they just smash right through that technical line?
They absolutely could. But doing so would be financial suicide for their own returns.
Why?
Because institutions move millions of shares. If a portfolio manager just hits the, sell at market button for 10 million shares, the supply instantly overwhelms the demand.
The price plummets vertically.
Right, and they ruin their own average exit price. They might start selling at 450, but by the time the order finishes filling, they're getting 390 a share.
Oh, I see.
They need liquidity. They need a place where thousands of buyers are already lined up, willing to take the other side of the trade.
And where are all those buyers gathered? They're clustered exactly at the 200-day moving average.
Exactly. So institutions use these technical lines as transaction zones. It's the only place they can move massive volume without immediately crashing the price.
It's like jumping out of a burning building into a giant foam pit.
The foam pit, I like that.
Yeah, like if you have to dump a massive heavy position, you aim for the foam pit. If that pit is placed at a high-volume node, like a major moving average, it absorbs the sheer weight of your sell order like a sponge.
Yes.
It gives you the liquidity to get out of the building safely without breaking your legs, or in this case, without destroying your average fill price.
That analogy perfectly captures the mechanics of institutional block trading. And there is a classic philosophy taught early on in the Chartered Financial Analyst program that captures the relationship between the fundamentals and the technicals.
Oh, what is it?
They say that intrinsic value is like a dog, and the market price is the man walking the dog.
Okay.
The dog eventually always goes home, meaning the stock will eventually return to its fundamental, mathematically sound valuation.
Right.
But the man wanders all over the street along the way. He crosses the road, looks at a tree, goes backwards. Technical analysis isn't studying the dog, it's studying the man's wandering.
I love that. So if support levels represent where buyers feel safe, where the man feels comfortable walking, what happens when that safety net breaks, the foam pit isn't there, and sheer terror sets in?
Well, then things get chaotic.
Right. If the man drops the leash and sprints into oncoming traffic, how do we actually measure that panic? Because right now, the tech sector feels incredibly panicked. But panic is an abstract word.
It is.
The sources show we actually have precise mathematical tools to measure this fear, starting with the Relative Strength Index, or RSI, and implied volatility, or FDI.
Yes, in finance, we don't just guess if people are scared. We measure the velocity of their fear. Let's start with RSI.
Okay, what exactly is RSI?
This is an oscillator that measures the speed and magnitude of recent price changes to evaluate overvalued or undervalued conditions. It runs on a scale from 0 to 100.
Right.
Traditionally, a reading below 30 is considered an extreme oversold condition.
So looking at the data from the sources, NVIDIA's RSI recently plummeted into the 26 to 27 range.
Which is very low.
Yeah, and Microsoft is sitting moderately oversold in the 36 to 42 range. And Amazon is actually surprisingly resilient, sitting up at 56.
Yes.
What does a 26 on NVIDIA actually mean in practical terms?
It means the selling pressure has been so relentless and so incredibly fast that the stock price is mathematically stretched like a rubber band.
Ah.
The algorithms calculate that the price has deviated too far, too fast from its average historical movement. The lower that RSI number goes, the more violently stretched the rubber band becomes.
And I'm guessing the more violent the snapback rally will be.
Exactly. The more violent the eventual snapback rally is likely to be when the selling pressure finally exhausts itself.
And what about Amazon at 56?
Amazon sitting at 56 means it is incredibly stable. It's neither overbought nor oversold. It's just drifting within its normal statistical parameters.
But RSI is kind of a rear view mirror, right? It only tells us what the price has done over the last 14 days. If we want to know what the market is anticipating, what the market is feeling right now, we have to look at the options market, specifically implied volatility.
Exactly. Implied volatility, or 5, is essentially the pulse of market fear. When investors get scared, they buy insurance.
And in the stock market, insurance takes the form of put options.
Right. Put options give you the right to sell your stock at a fixed price, protecting you from a crash. When everyone rushes to buy put options at the exact same time, the price of those options skyrockets.
What's the demand?
Yes, and that price increase is represented as a spike in implied volatility.
And we look at the IV percentile to understand if that fear is normal or historic. Right now, the sources show NVIDIA's 5V percentile has hit an extreme 75 to 82%.
Which is staggering. That means that over the past trailing year, the options market has only been this terrified 18 to 25% of the time.
It is a state of peak panic.
Everyone is buying fire insurance. By contrast, Amazon is sitting at an abnormally calm 24.3% IV percentile.
So options traders are completely unbothered by Amazon's current price action.
Exactly.
Now, intuition would tell you that if IV is in the 80th percentile, everyone is terrified, and panic is highly contagious.
You'd think so.
Yeah, if everyone is rushing for the exits, shouldn't the stock just keep dropping? Why do the sources explicitly argue that peak fear is actually a mathematical signal to buy?
This brings us to a crucial market mechanism called capitulation. You have to think about the actual physical supply of stock shares.
Okay, walk me through it.
When implied volatility hits these extreme percentiles, the panic is so widespread that every single investor who is prone to fear has already hit the sell button.
The weak hands are gone.
Exactly. The weak hands have been completely flushed out. The portfolio managers who wanted to hedge their positions have already paid exorbitant premiums to buy their protective put options.
Right.
At that exact moment, the supply of available sellers in the open market is physically exhausted. There is simply no one left who wants to sell.
So even if a tiny trickle of positive news hits the wire, or frankly, even just the absence of bad news on a given Tuesday, it creates this massive vacuum that sends the stock shooting upward simply because there is zero overhead resistance.
That's part of it.
Yeah.
But there is a deeper structural trap here involving the massive institutions that actually write those options contracts.
Yes, the delta hedging trap. This is one of the most powerful invisible forces driving modern market volatility.
It really is.
How does it work?
When retail investors and mutual funds panic, they buy put options. But for every buyer, there must be a seller. The entities selling those puts are Wall Street market makers, massive quantitative firms in Chicago and New York.
But here is the critical thing to understand, right?
Yeah.
Market makers are not gambling.
Oh, absolutely not.
They do not want directional risk on NVIDIA. They don't care if the stock goes up or down. They just want to collect the transaction fee, the bid-ask spread.
But if they sell a put option, they are technically taking on risk. They're betting the stock won't go down. If it crashes, they are on the hook to pay out millions.
So how do they neutralize that risk?
They hedge it dynamically in the open market. When a market maker sells a put option, they have to offset that exact amount of risk by physically shorting the underlying stock.
Automatically.
Yes. They look at a metric called delta, which tells them exactly how many shares to short for every options contract they sell.
So let me walk through the mechanics of this trap. The retail investor gets scared and buys a put.
Okay.
The act of them buying that insurance forces the massive market maker to go out and aggressively short the stock.
Right.
Which means the attempt to buy protection actually adds tremendous selling pressure to the open market, driving the price down even further.
Precisely. It creates a brutal feedback loop. The retail panic drives the stock down. As the stock goes down, the put options become more in the money, which means their delta increases.
And then what?
The market maker's algorithm sees the delta increasing, so it automatically shorts more stock to stay hedged. This accelerates the crash.
But what happens when the selling finally stops? Like when capitulation hits and there are no retail sellers left?
The feedback loop violently reverses. The moment the stock stops falling and stabilizes, those expensive put options start losing value rapidly.
Because of time decay.
Yes, time decay eats away at them, and the fear subsides. As the value of the puts drops, the delta drops.
Right.
The market makers suddenly realize their algorithms are holding way too many short positions. They no longer need to be heavily short the stock to hedge their risks.
So what do? They
have to close those short positions by buying the stock back.
Oh, wow. So millions of shares are suddenly bought back automatically by the biggest, most well-capitalized players on Wall Street.
Exactly. And because the supply of retail sellers is already exhausted, this massive wave of algorithmic buying hits an empty market. It causes a violent vertical V-shaped recovery.
And what happens to all those retail investors who bought the put options at peak panic?
They get completely obliterated by a phenomenon known as via crush.
Via crush.
When the market realizes the fire isn't spreading, the implied volatility collapses overnight. The cost of insurance drops from the 80th percentile back to the 30th.
It's exactly like trying to buy fire insurance when your neighborhood is already engulfed in flames.
Yes.
The premiums you pay the insurance company are extortionate. If the fire department shows up and puts the fire out 5 minutes later, your house is safe. But the value of that expensive insurance policy drops to zero instantly.
Yep.
You've lost all the capital you paid for the premium.
That is exactly the dynamic.
Right.
Which is why the sources stress that setting tight, hard stop losses on your long-term stock holdings is incredibly dangerous in high V environments.
Wait, is it dangerous?
Because if you set an automatic sell order at, say, 170 for NVIDIA, a brief, chaotic morning panic driven by market maker hedging might trigger your stop loss.
And then your broker automatically liquidates your entire position at the exact bottom of the gap down.
Exactly. You lock in a massive loss, you trigger a taxable event that ruins your long-term capital gain status, and then you just sit there helpless.
Well, the market makers buy back their shorts and the stock stages a 5% V-shaped recovery by lunch.
You get shaken out right before the rally.
So practically speaking, what does this mean for you, the listener, sitting on that Amazon position?
Right. What's the move?
If buying insurance is mathematically a losing game because of IV crush and setting stop losses just gets you shaken out by the algorithms, what is the actionable takeaway when the market is terrified?
The strategy is to flip the table. Instead of buying the expensive insurance, you act as the insurance company.
Okay, how?
The sources outline a very specific strategy regarding that Amazon support level. With Amazon currently testing that $200 anchor, and with the broader market fear elevating premiums, you can choose to sell cash-secured puts at a $200 strike price.
So instead of paying the premium, I am collecting it from the terrified retail investor.
Exactly. You write the contract, you say, I am willing to buy 100 shares of Amazon at $200 a share anytime between now and the expiration date.
Right.
In exchange for taking on that obligation, the fearful buyer pays you a massive cash premium up front. Let's say they pay you $5 a share. That is $500 in hard cash deposited straight into your brokerage account today.
And there are really only two outcomes here.
Right. Scenario A. The market panic subsides, and Amazon holds the $200 support line and bounces higher.
Then what?
The put option you sold expires worthless. You don't have to buy the stock. And you keep the $500 premium as pure profit. You generated a yield simply by providing a psychological safety net to someone else.
And scenario B, the floor breaks.
Scenario B, Amazon crashes to 190. You are legally obligated to buy those 100 shares at 200. But remember, you already collected $5 per share up front.
So your actual true break-even cost isn't 200, it's 195.
Exactly. If you love Amazon as a business long-term, you just got paid $500 to wait patiently and acquire the stock at a discount to where it was trading yesterday.
It is a massive paradigm shift. You literally monetize the market's fear to lower your own cost basis.
But that strategy hinges entirely on one very specific assumption.
Which is?
It assumes that Amazon is actually a fundamentally sound business worth owning at $200 a share. Selling a put gets you paid to wait for a discount, but how do you even know the asset is valuable once you look past the ticker tape panic?
To figure that out, we have to transition away from market psychology and strip away the accounting illusions. We have to look at the raw cash.
Which brings us to arguably the greatest illusion in modern corporate finance: the massive disconnect between net income and operating cash flow.
This is huge.
If we look at fundamental CFA accounting, you have to realize that net income, the bottom line profit number that gets blasted across financial news networks, is based on accrual accounting.
And accrual accounting is highly subjective.
Very. It is filled with estimations, non-cash deductions, and management assumptions. It is incredibly easy to distort.
So what's the alternative?
Operating cash flow, or OCF. It strips all of that subjective narrative away. It tracks the actual physical, cold, hard cash hitting the company's bank account.
So how do we actually find that real number? How do we bridge the gap between the story management tells the press and the reality of the bank account?
We use what accountants call the indirect method. You start with the net income at the very top of the cash flow statement.
Okay.
Then you systematically add back all the non-cash expenses that accountants force the company to deduct, but which never actually required writing a check.
And what are those?
The two biggest non-cash charges in the tech sector are depreciation and amortization and stock-based compensation.
Right.
Finally, you adjust for changes in working capital, things like unpaid bills from suppliers or revenue sitting in accounts receivable that hasn't actually cleared the bank yet.
Let's ground this in the actual numbers for Amazon from the sources, because the discrepancy is staggering.
Like, it really is.
Amazon reported a net income of $30 billion. That is the number everyone read on the front page of the Wall Street Journal.
Yep.
But if you scroll down to their operating cash flow, the number was $139.5 billion. That is a discrepancy of over $100 billion.
It's massive.
How on earth does a publicly traded company hide $100 billion of cash flow from the headline profit number?
Well, they aren't hiding it maliciously. The strict rules of U.S. GAAP accounting mathematically require them to deduct it to calculate profit, even though the cash never left the building.
Okay, so what makes up that $100 billion?
For Amazon, the bridge between those two numbers primarily consists of roughly $40 billion in depreciation and $20 billion in stock-based compensation.
Let's tackle depreciation first, because it is the biggest lever.
Right, because Amazon operates massively physical infrastructure alongside their digital businesses.
Yeah, years ago, Amazon spent tens of billions of dollars physically building data centers for AWS and massive fulfillment warehouses for retail.
Exactly. And under accrual accounting rules, you don't get to deduct the cost of a building from your profits the day you buy it.
No.
No, instead you have to spread that cost out over the useful life of the asset. The accountants force Amazon to deduct a portion of that historical cost from their profits every single year as the buildings age and wear down.
So that $40 billion depreciation charge is subtracted from their $70 billion gross profit, driving the reported net income down to $30 billion.
That's the math.
But the critical question is, did Amazon actually write a physical check for $40 billion this year to maintain those old buildings?
No, the cash was spent years ago. The depreciation is purely a paper entry to account for wear and tear.
Oh, wow.
The $40 billion in actual operating cash generated by the business this year stayed entirely within Amazon's corporate bank accounts. So to find the real cash flow generating power of the company, we take the $30 billion net income and we add the $40 billion in depreciation right back in.
And suddenly, we are at $70 billion in cash flow.
Exactly.
You know, net income is essentially a heavily filtered Instagram photo. Management and accountants massage it, tweak it, and apply filters to make the earnings trajectory look smooth and predictable for Wall Street analysts.
I like that, yes.
Operating cash flow is the raw, unedited camera roll. It might be bumpier, it might not look as perfectly curated, but the raw camera roll tells you the absolute truth about what actually happened in the room.
That is exactly right. And the same logic applies to the second massive add back, which is stock-based compensation.
Oh, okay. How does that work?
Amazon deducts $20 billion from their profits to account for the massive compensation packages they give to their software engineers and executives.
Because it's counted as an operating expense.
Yes, but they didn't hand out $20 billion in physical cash. They literally just printed new shares of Amazon stock and handed those to the employees.
So the company's cash balance never actually dropped.
Right. So again, that $20 billion stays in the bank and gets added back to operating cash flow, pushing our total even higher.
Hold on, I need to stop you there
Yeah.
because we are talking about historical spending. But right now, today, Amazon is spending an astronomical amount of money in the AI arms race.
Oh, massive amounts.
They are buying tens of billions of dollars worth of NVIDIA servers. Why doesn't that massive, immediate cash outlay instantly wipe out their net income for the quarter?
It's a great question.
If I spend $100 billion on servers, shouldn't my profit be negative $100 billion?
You've just hit on the exact mechanism that makes tech valuations so complex during a hardware cycle. It all comes down to the matching principle in accounting.
The matching principle.
Yes. When Amazon buys a $100 million AI server cluster from NVIDIA, the accountants argue that the server is going to generate revenue for the company for the next 5 years.
Okay, that makes sense.
Therefore, it is unfair to penalize this year's profit for an asset that will benefit future years. If they deducted the whole $100 million from net income today, it would look like Amazon is hemorrhaging money and facing bankruptcy.
So what do they do with that massive expense?
It gets capitalized. That $100 million expense bypasses the income statement entirely. It goes straight onto the balance sheet as a physical asset. Then, over the next 5 years, it slowly trickles down onto the income statement as a depreciation expense.
But wait a minute. Regardless of what the accountants say about 5-year lifespans, Amazon still had to write a real physical check to NVIDIA for $100 million today.
Yes, they did.
The cash did leave the building. So if it doesn't show up in net income and it doesn't reduce operating cash flow, where on earth do investors see that the money is gone?
It shows up when we calculate free cash flow, or FCF. This is the ultimate metric for valuation.
Okay, how do we calculate it?
You take that massive, beautiful operating cash flow number, $139.5 billion for Amazon, and you subtract capital expenditures, or CapEx.
And CapEx represents the actual cash spent on physical assets this year.
Exactly. That subtraction shows you the actual cash left over after paying for the future of the business.
And the sources emphasize that depending on who you are as an investor, you calculate free cash flow differently.
Yes, there's a critical distinction here.
Right, between valuing the whole enterprise versus just valuing the stock.
It revolves around debt and interest payments. Under standard U.S. GAAP accounting, the interest payments a company makes on its debt are already deducted when calculating operating cash flow.
Okay.
But let's say you are a massive private equity firm and you want to buy out the entire company, taking over both its equity and its debt.
Right, you want the whole thing.
You need to calculate free cash flow to the firm, or FCFF. To get this number, you take operating cash flow, subtract CapEx, but then you must add back the after-tax interest payments.
Why do you add them back?
Because, as the total owner of the firm, that cash is technically available to you to pay off the debt holders however you see fit.
But I'm not a private equity billionaire. I'm a retail investor holding 200 shares.
Yeah.
I only care about the cash that belongs to me, the shareholder.
In that case, you calculate free cash flow to equity, or FCFE. This is the cash available exclusively to shareholders.
How does that formula work?
You take operating cash flow and you subtract CapEx. But then you add net borrowing. Net borrowing is the total new debt issued by the company minus the old debt repaid.
Wait, why would I add borrowed money to my cash flow?
Because if Amazon decides to borrow $10 billion from the bond market to pay for those NVIDIA servers, instead of using their own operating cash, they have effectively saved the shareholders from footing the bill this year.
Oh, I see.
That $10 billion is now theoretically available to be paid out to you as a dividend or used to buy back your shares.
So Amazon looks like an absolute cash printing machine when you look at the raw, unedited camera roll of operating cash flow.
It really does.
But the sources reveal something incredible. A massive part of that $139.5 billion in cash doesn't actually come from selling products.
No, it doesn't.
It comes from a very specific structural superpower. Amazon's ability to hold on to other people's money. Where is that cash actually sitting on a Tuesday afternoon?
This brings us to the cash conversion cycle, or the CCC. If you want to understand the true power dynamics of the global economy, you don't look at market cap.
You look at the cash conversion cycle.
Yes. This single mathematical formula answers a fundamental question. Who is the actual boss in the supply chain?
Right. Let's break down the formula. The CCC equals days inventory outstanding plus days sales outstanding minus days payable outstanding.
Exactly.
Essentially, it measures how many days it takes you to sell a product off the shelf, plus how many days it takes you to collect the cash from the customer, minus how many days you can aggressively delay paying the supplier who made the product.
Let's run the data showdown between the tech giants, because the numbers here are incredibly revealing about their underlying business models.
Okay, let's start with Amazon.
Their days inventory outstanding is 37 days. It takes them roughly 37 days for a product to enter a warehouse and be shipped to a buyer.
That's pretty fast.
Yeah. Their day sales outstanding, which is how fast they collect money from customers, is a lightning fast 26 days, thanks to credit cards and instant digital payments.
Okay, so that's the inflow.
But their days payable, outstanding how long they wait to pay the vendors and suppliers who actually manufacture the goods, is an astonishing 111 days.
Let me make sure the math is clear here. 37 days of inventory plus 26 days to collect the cash equals 63 days total to complete the sales cycle.
Right.
But they don't pay the supplier for 111 days. 63 minus 111 gives Amazon a cash conversion cycle of negative 48 days.
Exactly. Think about what that actually means in the real world. A customer buys a pair of running shoes on Amazon.
Okay.
Amazon's bank account receives the cash from Visa within a day or two. But the vendor in Vietnam who manufactured that shoe signed a contract agreeing to net 111-day payment terms.
So Amazon physically holds the customer's cash for over 3 months before they pay the manufacturer.
That is ruthless.
And because Amazon is so massive and their sales volume never drops to zero, they are doing this continuously with millions of products simultaneously.
Yes, and that creates what we call a permanent float.
A float.
Holding on to suppliers' money for an extra 48 days creates a rolling, permanent pool of tens of billions of dollars. It is essentially an infinite, zero-interest loan provided forcefully by the global supply chain.
And what does Amazon do with those billions of dollars of free cash? They don't just leave it in a checking account.
Definitely not. They use it to fund the massively capital-intensive, high-margin AI infrastructure required for their AWS cloud business.
It is the ultimate financial arbitrage. It's exactly like paying for your weekly groceries with a magical credit card that charges absolutely zero interest and doesn't require a minimum payment for 3 months.
Exactly.
You take the cash you would have spent on groceries, put it into a high-yield savings account earning 5%, and keep the profit. You are literally generating wealth simply by delaying the outflow of capital.
It's brilliant.
What about Microsoft? They don't sell running shoes.
Microsoft plays a completely different game, but it's still highly efficient. Their days inventory outstanding is virtually non-existent, sitting at just 5.8 days.
Because software subscriptions and cloud compute don't sit in physical warehouses.
Exactly. However, their days sales outstanding is much slower. It's 69 days.
Why does it take Microsoft over 2 months to collect their cash?
Because they aren't swiping credit cards from retail consumers. They are selling massive, multi-million-dollar software contracts to enterprise clients, governments, banks, Fortune 500 companies.
And those massive entities demand 60 or 90-day payment terms.
Right. But Microsoft is also a behemoth. They have massive leverage over their own suppliers and server manufacturers. So Microsoft delays paying its own bills for 96.7 days.
So 5.8 plus 69 minus 96.7 results in a cash conversion cycle of roughly negative 22 days.
Which is still highly efficient.
Yeah, still generating a massive float of free cash, but not quite the ruthless supply chain vacuum that Amazon operates.
Right.
And then there is Google. The sources point out that Google actually has a positive cash conversion cycle of 30 days. How is that even possible for a purely digital ad company that doesn't manufacture anything?
Google is a unique case study because of a structural weakness known as traffic acquisition costs, or TAC.
Okay, explain that.
When Google displays an ad on a smartphone and earns revenue from a small business, a massive chunk of that revenue has to be shared with partners. The most notable partner is Apple.
Right.
Google pays Apple tens of billions of dollars a year just to be the default search engine on the iPhone.
And Google cannot bully Apple on payment terms the way Amazon bullies a shoe manufacturer.
Precisely. Apple demands their cut immediately. So Google is forced to pay out those massive TAC fees very quickly, often before they have even fully collected the ad revenue from the millions of small businesses running the campaigns.
Oh, wow.
Because Google lacks supply chain dominance over its key distribution partners, their cycle is positive 30 days. The cash sits in their own bank accounts for 30 days less than it takes to complete the entire transaction cycle.
You know, I have to challenge this premise regarding Amazon's float being viewed as a pure asset.
Okay, let's hear it.
We are treating Amazon's massive payables balance like it's a brilliant cash generation engine. But at the end of the day, payables are just unpaid bills. It is a liability.
It is.
Is it really fair to analyze that as quote-unquote cash flow if they eventually have to pay every single dollar back? A debt is a debt.
It is a valid conservative accounting objection. But you have to view the business dynamically, not statically.
What do you mean?
Yes, individually, every single bill is eventually paid. But as long as Amazon's overall retail volume is growing, or even just staying perfectly flat, new unpaid bills are constantly replacing the old ones that are being paid off.
Oh, I see.
The pool of float never actually drains. It functions as a permanent feature of their capital structure.
So as long as the music keeps playing, the pool stays full.
Exactly. Contrast this dynamic with Walmart. Walmart is the only other retailer with the sheer scale to bully suppliers like Amazon.
Right, they are huge.
They also boast an incredible negative cash conversion cycle and generate massive amounts of free cash. But Walmart has a structural problem.
What is it?
They don't own an AWS equivalent. They don't have a high-margin, hyper-growth technology engine to pour that free cash into.
So what does Walmart do with their float?
They use it defensively. Lacking a massive internal growth opportunity, Walmart pours its cash into massive dividend payouts and stock buybacks.
So they operate a mature dividend king strategy.
Exactly. They are returning capital to shareholders because they cannot find better internal use for it, whereas Amazon is weaponizing its float to fund radical AI capital expenditures.
So if Amazon is playing the ultimate cash flow game, and they have this unbelievable structural advantage with their float, why does Microsoft's stock look so much safer and trade at a much higher multiple to the casual observer?
That is a great question.
It all comes down to the battle between stock yields and risk-free government bonds.
We are entering the realm of the Fed model and equity risk premiums.
Okay, break that down for us.
If you want to understand how a massive institutional fund manager values a tech stock, you have to realize that the ultimate gravity in finance isn't the stock market at all. It is the bond market.
Specifically, the yield on the 10-year U.S. Treasury bond, which is currently hovering around 4.0 to 4.2%.
Because the Treasury yield is considered mathematically risk-free. The U.S. government guarantees that return.
Right.
So every institutional investor looks at a volatile tech stock and asks a very simple question. How much extra yield am I getting to compensate me for the risk of a market crash instead of just sitting safely in a guaranteed government bond?
Yeah, exactly. We measure the stock's return using the earnings yield, which is simply the inverse of the price-to-earnings ratio.
Right. Instead of dividing price by earnings, you divide earnings by price to get a percentage yield.
Let's look at Microsoft's severe vulnerability here. Right now, Microsoft is trading at roughly a 24x or 25x PE ratio. If you invert that, their earnings yield is roughly 4.1%.
And that is a massive problem.
Why?
Because if the 10-year Treasury pays 4.2% and Microsoft's earnings yield is 4.1%, the equity risk premium, the extra reward the investor gets for taking on stock market risk, is literally zero. It's actually slightly negative.
So Microsoft is currently priced for absolute perfection. Investors are accepting a lower yield than a risk-free bond because they are entirely banking on the G in the valuation models. Growth.
Yes, they believe Microsoft's aggressive AI integration will cause future earnings to grow by 15 or 20% a year, whereas a bond's yield is fixed forever.
But it is a terrifying tightrope walk.
It really is.
If Microsoft's AI revenue growth slows down by even a fraction of a percent in the next earnings call, the market will instantly realize they are not getting compensated for the risk.
And then that 25x multiple will collapse violently as institutions dump the stock and flee back to bonds.
But the sources indicate there is a safety net below Microsoft, a mathematical floor where the selling stops.
Yes. Historically, a 21x PE ratio has acted as an iron floor for Microsoft during major corrections.
Okay, let's do the math on that.
If you invert a 21x PE, you get an earnings yield of 4.76%. At that specific level, the stock's yield definitively beats the 4.2% government bond.
So once the stock drops to 21x, it triggers massive automatic institutional buying. Pension funds and asset managers reallocate capital from bonds back into the stock, arresting the fall.
Exactly.
Let's pivot to Amazon because understanding the earnings yield completely changes how you view their valuation. On paper, Amazon's PE ratio always looks absurdly high.
It does. Traditional value investors screen for low PE stocks and instantly pass on Amazon.
And that is exactly where understanding the difference between net income and operating cash flow pays massive dividends.
Because Amazon's massive depreciation charges artificially depress their net income, their PE ratio looks wildly expensive.
Right.
But if you calculate Amazon's price to operating cash flow POCF, its real-time multiple is only 16.1x.
So if we invert a 16.1x multiple, what is the actual cash yield?
It gives you an operating cash flow yield of 6.2%.
Wow.
Compare that to the 4.2% 10-year Treasury. Amazon gives investors a fat, comfortable plus 2.0% equity risk premium.
It is a massive margin of safety.
It really is. Amazon's valuation is deeply misunderstood by casual observers because the company is functionally torn in half. It is a low-margin retail business stable to a high-margin AWS cloud business.
The retail business has razor-thin margins of maybe 2 or 3%. AWS operates with staggering operating margins of 35.4%.
Exactly. The low-margin retail side depresses the overall corporate net income, which inflates the PE ratio and scares away amateur investors.
But the retail side provides the massive cash pool, the negative CCC float that funds the AWS side.
The cash flow reveals the true, underlying defensive power of the asset.
And then there's Google, sitting there quietly as the undeniable value king of big tech.
Mathematically, there is no debate. Google trades at a 21x PE ratio. Inverting that gives you a 4.76% earnings yield, which offers a solid, immediate plus 0.81% spread over government bonds.
It is the cheapest of the tech giants on paper.
But cheap usually comes with a catch. And for Google, the sources detail a massive structural catch.
Right. They are forced to pay a multi-billion-dollar toll fee every single year just to maintain their monopoly.
We are talking about the hidden drains on a tech company's balance sheet, starting with Google's traffic acquisition costs, or TAC.
How big is that drain?
Google pays out an astonishing 20 to 22% of its entire ad revenue just to distribution partners.
That's incredible.
The most critical piece of that is the roughly $20 billion in pure cash they send directly to Apple every single year for one single privilege.
Which is to remain the default search engine on the Safari browser across all iOS devices.
Exactly.
Look, I have to ask the obvious question here. Google's search product is vastly superior to the competition. It is literally a verb in the English language.
Sure.
Why on earth would they voluntarily hand Apple $20 billion? If Apple switched the default to Bing, wouldn't 99% of iPhone users just open Safari, manually type in google.com and use it anyway?
They are paying $20 billion because of the default
effect.
Human laziness is genuinely one of the most powerful and predictable economic forces on the planet. If Google doesn't pay that massive TAC fee, Apple will happily take Microsoft's money and make Bing the default.
Right. And yes, power users will manually type in Google.
But millions of average consumers won't bother changing the settings in their phone. They will just search on whatever pops up.
And why is that a localized disaster for Google?
Because search algorithms run entirely on data volume. If Bing suddenly becomes the default for a billion iPhones, Bing gets a massive, unprecedented influx of user query data.
I see.
Bing's algorithms use that feedback loop to improve dramatically overnight. They figure out what people are actually looking for. Suddenly, the quality gap between Google and Bing closes.
So Google isn't paying Apple $20 billion to acquire users. They are paying $20 billion to defensively starve their competitors of the data oxygen needed to survive.
Exactly.
It is exactly like the layout of a physical grocery store. Consumer packaged goods companies pay supermarkets millions of dollars in slotting fees to ensure their cereal is placed exactly at eye level on the shelf.
That's a great comparison.
It doesn't matter if the cereal on the bottom shelf is technically healthier or tastes better. The eye-level cereal wins the market share purely through frictionless convenience.
Yep.
Google is essentially paying a $20 billion slotting fee for eye-level placement on the iPhone. But we absolutely must note here, impartially reporting the sources, that the Department of Justice is currently suing Google under antitrust laws to completely ban this specific practice.
And the mechanics of that DOJ lawsuit present a fascinating structural paradox for Google's balance sheet.
How so?
If the DOJ wins the lawsuit and bans the payment, Google instantly saves roughly $20 billion a year. Over a few years, that is $50 billion in cash kept internally.
But what's the trade-off?
They risk a massive, unquantifiable loss of mobile traffic to competitors. If Google wins the lawsuit and defends their business practice, they get to keep their impenetrable moat, but they are condemned to keep paying that extortionate margin-crushing fee to Apple forever.
It's a structural drain either way.
It really is.
Another massive hidden drain explicitly detailed in the sources across all these tech companies is stock-based compensation, or SBC. We mentioned earlier that Amazon issues $20 billion in stock to its employees instead of paying cash.
Right.
How does this physically impact the retail shareholder sitting at home?
It acts as a silent, slow-moving tax on your ownership. To attract top-tier AI engineers, tech companies issue massive amounts of new stock.
Which is brilliant for corporate liquidity because it saves the company billions in cash today.
But for the shareholder, it creates severe dilution. Imagine you own a slice of a pizza. Every time the company issues new shares to an engineer, they're essentially slicing the pizza into smaller and smaller pieces.
Your percentage ownership of the total company shrinks every single quarter without you doing anything.
Exactly.
So how do tech companies prevent their stock price from bleeding out due to this massive dilution?
They counteract it by weaponizing their free cash flow to execute massive share buyback programs.
Oh,
They take billions of dollars of their own cash, go into the open market, and buy their own stock from willing sellers. Then, they permanently retire or destroy those shares.
By shrinking the total number of shares in existence, they force the pizza slices to get bigger again, offsetting the dilution caused by employee compensation.
That is exactly how it works.
What about the cash drain of dividends? Microsoft pays a substantial dividend, returning cash to shareholders. Amazon aggressively refuses to pay a dividend.
The sources outline a very strict mechanical reality regarding dividends. They are fundamentally a transfer of wealth, not the creation of wealth.
Right, many retail investors view a dividend as a bonus payment.
But the mechanics of the exchange dictate otherwise. On the ex-dividend date, the day the dividend is officially processed, the stock price physically drops by the exact amount of the dividend paid.
Walk me through exactly how that happens. Doesn't the open market dictate the stock price based on buyers and sellers? How can the exchange just automatically decide to drop the opening price?
It is mathematically forced by the rules of no arbitrage. Imagine a company has a stock price of $100. That company has exactly $1 in pure cash per share sitting in its bank account.
Okay, tracking.
The company announces it is paying out that $1 to the shareholders. The moment the cash leaves the corporate bank account, the company itself is objectively, mathematically worth $1 less.
Right.
If the exchange didn't adjust the opening price down to $99, you'd see absolute chaos from high-frequency traders.
An arbitrage opportunity.
A risk-free arbitrage opportunity. A high-frequency trading firm would buy millions of shares at 3:59 p.m. the day before, collect the $1 dividend overnight, and then sell the shares at 9:30 a.m. the next morning for $100.
They would generate infinite risk-free money.
To prevent this, the clearinghouses mechanically mark the opening price down by the exact amount of the dividend.
Wow.
Amazon deeply understands this wealth transfer logic. They refuse to pay dividends because they fundamentally believe that keeping the cash inside the company, using it to build more AWS data centers, generates a far higher long-term market value than handing a $2 dividend back to an investor.
Plus, if they hand it to the investor immediately has to pay income tax on it.
Exactly.
Speaking of taxes and cash management, the sources highlight one final puzzle. Google has $126.8 billion in cash sitting on its balance sheet, yet they actively issue billions of dollars in corporate debt.
They do.
If you have $126 billion in the bank, why on earth would you borrow money and pay interest?
It is a masterclass in capital arbitrage and tax shielding. You have to look at the mechanics of the U.S. tax code. The interest payments a corporation makes on its debt are legally tax deductible.
Okay, let's look at the math.
Suppose Google issues $10 billion in corporate bonds at a 4.5% interest rate. Because they get to deduct that interest from their taxable income, their effective real-world borrowing cost after the tax shield might only be 3.5%.
Okay, so they are effectively borrowing at 3.5%. But what do they do with their own massive pile of cash?
They take their $126.8 billion in cash and invest it in short-term U.S. Treasury bills, which are currently yielding roughly 5.83%.
Ah, I see.
So they're borrowing money at an effective rate of 3.5% and earning 5.0% on their own cash pile.
They're literally generating hundreds of millions of dollars in pure profit just from the spread between their shielded borrowing cost and their cash yield.
Yes. And simultaneously, they keep their massive cash pile completely liquid, allowing them to instantly deploy it if a major AI acquisition target presents itself.
Incredible. We have covered an immense amount of ground today, pulling apart the absolute extremes of how tech giants are valued.
We really have.
We started with the raw, visceral emotions of support lines. You know, the regretful buyers, the greedy holders, the fearful short sellers forced to cover.
Right, the psychology of the chart.
We measured the sheer panic of the options market through implied volatility and broke down the mechanical trap of delta hedging that triggers violent V-shaped recoveries.
And then we got into the accounting.
Yes, we stripped away the heavily filtered Instagram photo of net income to reveal the raw camera roll of operating cash flow. We explored how Amazon weaponizes its 111-day payables to create an infinite float.
And how tech balance sheets are quietly drained by traffic acquisition costs, stock-based compensation, and the mechanical reality of ex-dividend.
Exactly. So for you, the listener, sitting there holding that Amazon position at $227 during a massive market freakout, the blueprint from these sources is clear. Look past the panic of the ticker tape.
Ignore the wildly inflated PE ratio.
Understand the structural advantage of a negative cash conversion cycle, and recognize the massive defensive margin of safety provided by a 16.1x price to operating cash flow multiple.
And as we close, the market is a constantly shifting mechanism. The moats we discussed today are not guaranteed forever.
True.
Which leaves us with a final, highly complex puzzle to consider regarding Google, Apple, and that $20 billion traffic acquisition cost.
The default effect. What threatens it?
We are currently witnessing a massive behavioral shift. Consumers are moving away from searching for lists of blue links on Google and transitioning toward asking conversational AI assistants like Gemini, ChatGPT, or Claude for direct, immediate answers.
The industry calls this the shift to zero-click searches.
Exactly. As this accelerates, the fundamental question becomes, will the entire concept of a traffic acquisition cost completely disappear, freeing up tens of billions of dollars for Google?
Or, as the hardware evolves, will tech giants simply be forced to pay a brand new, vastly more expensive kind of toll directly to the AI hardware and device manufacturers just to survive the next decade?
Will the toll booth vanish, or will it just change its name and raise its prices?
That is a phenomenal puzzle to mull over. Thank you for taking this deep dive with us today. Keep questioning the headlines, keep stripping away the accounting illusions, and remember that behind every mechanical algorithm and every line on a chart, there is human psychology driving the machine. Until next time.